Hello and welcome to AGRC 221 Ag Marketing. This will be the first of our video series of lectures in this course, and we'll start with Unit 1, Introduction to Commodities Marketing, and this will be segment 1. So let's get into this first half of Unit 1 lecture. You all can read the objectives. We're going to try and lay out a little bit on how the market works and how it determines its information, what drives market prices up and down, a little bit on supply and demand and things of that nature, and just kind of a quick overview on hopefully how we'll start to apply these skills to your own grain merchandising or livestock merchandising business. So let's talk real briefly about what's going on today. Of course, we've got major advancements in genetics and technology. It's increased production dramatically. On average, if you look back, if we just talk about corn acres over the last few years, we're talking about 90 million acres of corn, give or take a few million acres, of course. But even if you just go back across the last 10 years of production, the massive leaps that we've had in genetics, technology, and management has driven average corn yields higher and higher and higher. So that creates a rather large challenging from a merchandising perspective to be able to support price. Demand has grown tremendously as well in many sectors, whether we're talking about livestock or grain, but it continues to ebb and flow up and down, and that dramatically affects price. So when we talk about recent growth, it's been beneficial and challenging for all sectors of the commodities marketing industry, whether it's producers, processors, handlers, whatever it might be. Everyone is in the business, of course, to make money, and you have to capture those opportunities wherever you can find them. A little bit on the evolution of the business of grain merchandising. We went from a period of development, to try and set up a little bit of a commodities exchange in the late 1800s. And that's really all the way where you kind of go back and see the foundations of futures contracts trading. And it started to revolutionize how cash grain was handled. It gave buyers and sellers more ability to trade on the open market and really kind of set the foundation for what we know as the markets today. We had some stagnation of the business until the Depression era of the 20s and 30s, and of course you see the advent of the tractor come along about then, which then of course makes the next great technological leap in production agriculture. Of course, then as you get into further evolution of the business, we went through a period of time where there was really heavy government involvement due to grain shortages or grain surpluses. We had a lot of government financed storage facilities built. And if you talk to your dad or granddad, you can probably catch some stories about the government bins that were built for some period of time. And that was meant to hold grain in storage to keep it all coming to market for a while. So we had a massive growth in grain stocks, but utilization of grain didn't. So we had of course, corresponding plunge in price. And that lasted really until the 1970s. So the government decided that, of course, that wasn't too profitable for them. So they exited the business in the 1980s. And as we kind of refocused, and the business then really started to revolutionize itself to basis trading and trying to really more of a risk mitigation tool to try and generate income. And really at this point in the 80s, we had a much larger supply than demand of the commodities that we talk about production. So we had to figure out how to have sizable drops in production to move prices significantly. And, if you think about the 1980s, there's just a few things that came along in that decade that tried to influence this. And one of them is the advent of the Conservation Reserve Program that pulled acres out of production to try and put them into, set aside is what it was called at that time. And many of you have heard of the CRP program now, but the government would pay you not to grow row crop on those. And it mainly was focused on high risk acreage that was highly erodible, not really suitable for row crop production, but trying to get that out of row crop production and yet give the producer a little bit of incentive to make a little bit of money on that. The other thing that happened in the 1980s to try and reduce supply, if you think about the dairy business, was the government buyout program. And there were lots of dairies in this local area that the government bought out their cows. They went through the buyout, liquidated their cows, got out of the dairy farming business, and the government paid them to do so. And that took a lot of milk off the market, and those cows went to slaughter. So what that did, or the goal of those programs, was trying to stabilize the market and create some profitable margins for good managers moving forward. Of course, you get to New Horizons. We have a much larger increase in population and living standards, and of course, worldwide. Now with a much more global market, we have to feed the world and try and move product quickly. And so that has increased the demand for food and food-related product. And so now we don't see grain that sits in storage for very long, and probably over the last couple of years has stretched out more than what it had for quite some time. So most grain is moving, and livestock product is moving quite quickly through the food chain. So to say, well, when now we're into a little bit of a different kind of market. There's more commodities used at a much faster pace than ever before. The market is much more sensitive and much more responsive to market needs than it was for many, many years. So we've really changed from a supply-driven market right now to a demand-driven market. Demand really influences today's prices quite a bit. So you say, well, what's the difference? A supply market is really steady and stable, and you wouldn't see big changes in production and price. The basis and spreads, and we'll talk more about basis later, are consistent and very predictable. And a price rally only happens if there's a pretty significant interruption in production. So you can think about just a couple examples here going backwards. 2012, we saw a pretty good interruption in production with the 2012 drought. I know on our home farm, we had several cornfields that were just tilled under because their estimated yield was 0. And probably one of the only fields that we combined that year averaged 20 bushel an acre. One of the greatest crop disasters of my lifetime. So that certainly influenced price because we took several hundred million bushels or several million bushels out of the balance sheet for corn and really interrupted the flow of grain in the business. So that kind of created a change there quite a bit. As you saw, going back even a little bit further than that, as you saw the advent of ethanol plants, which was kind of a little bit newer market, even though ethanol has been around since the 70s, 9/11, 2001, whenever we had the tragic attack in New York City, created all of a sudden a gas shortage, which then stimulated ethanol plants to come online, which stimulated more corn usage rate. And we had corn that was being utilized so quickly, demand skyrocketed and supply couldn't keep up for a little bit. And that's why you saw a huge spike in corn price in the 2005, 6, 7 area, where we were $6, $7, $8 a bushel. A demand market is oftentimes much more volatile. Price, basis, and spreads react a lot more quickly to what's going on. So rallies occur at any time and not just when the supply is short. So it's much more challenging to manage. The highs are high, the lows are low, and if you catch it on the wrong side of the flow or wrong side of the curve, you really miss a good pricing opportunity. If you catch it on the right side of the curve, you really did well. So if we look at the grain elevator, it's needed more now than ever. And lots of companies have shifted focus from distribution and export to value-added approaches. Companies want quantity and quality of grain large enough to meet demand because they're also filling contracts. And we also have many more products manufactured from the commodities that we're making. So it's been imperative that businesses locate as close as they can near to production. So just in your lifetimes, for example, all the ethanol plants that have popped up, they've been built near where corn production is in order to help fill that elevator need and production need much quicker. If we continue on that, there's more outlets for commodities too. So there's a benefit to the local grain elevator. They do supply a great service to the producer because they have available storage that you may not have on the farm. They have the ability to connect the producer, to the end user, whether that's an ethanol plant, whether that's taking it to the river and getting it on a barge to head overseas, or whether that's connecting it to Decatur to the soybean crush facility to be processed into animal feed and a number of other things. But it's a place where the buyer and seller meet effectively, but they've got different goals. And actually, there's very little cost to both of them. If we look then at how do you capture the opportunity, really the elevators don't make a lot of money anymore just by simple grain storage. They've also got to merchandise grain just as effectively as we're going to try and encourage you to do throughout this course. The grain elevator has to be active and aggressive sellers of grain to meet and make money and meet their needs and service their facility and continue to be able to take care of their employees. So they have to be able to provide quality service to you, the producer. And there's lots of discussion oftentimes about how quickly can I get through the dump and get across the scale through the dump and back on the road back home to refill again. Who's competitive? If you just think about the number of grain outlets that we have just in proximity to the college here, how competitive grain pricing and livestock pricing is. So an effective marketing plan and good advice to the producer is really helpful in helping them sell commodities at a profitable price. So you've got to be prepared to deal with big swings in the market, whether it's milk, livestock, or grain. Occasionally we'll see some pretty big swings in the market. And now the last few years, it's been a little bit more narrow than some of us would like. But you have to be ready for almost any situation in order to stay viable. You've got to be paying attention and reading the market. And I'll say over and over and over throughout this course is you need to be in tune with the news that's going on in the marketplace, what and how it's impacting the grain markets. So the definition of merchandising is that's the process that businesses go through to manage the purchase and sale of grain as its normal course of operation. It may be you, the producer, it may be the elevator manager, and it may be someone who procures grain for their business. And so you're trying to hone this skill to make it profitable for you for the bushels that you handle. And a merchandiser provides buyers, resellers, and users the opportunity to operate profitably. The challenges, of course, is we have constant price fluctuation, tremendous risk exposure for price if you don't do this correctly. So you got to be able to bridge the gap in the grain transaction over weeks, months, or years, because you can sell grain, you can sell grain 6 months to a year to 4 years ahead of time before it's ever even in the ground or even in the seed bag. Lastly, then here, the futures markets were developed to help minimize the price risk and give you opportunities to merchandise grain. They allow for businesses to much more time to complete those grain transactions like we were talking about. You can price bushels before you ever get them and kind of create a budget of how much grain you need to fill your contracts. So we're going to stop there for segment 1 of Unit 1 before we get into a little bit about basis and how some of that grain merchandising and livestock merchandising actually works from a nuts and bolts perspective. Thanks for tuning in to this segment of Unit 1, Introduction to Commodities Marketing.